Rising costs hit your wallet: groceries, fuel, rent squeezing tighter each year. If you've noticed your money buys less, it's not your fault. You're caught in a hidden wealth transfer, one that's been reshaping society for centuries. Welcome to Finance History Vault, where money, history, and power intertwine. And nothing is as straightforward as it seems. For most, inflation feels like a relentless enemy saving shrink. Bills grow, life gets harder. But for the elite, it's a calculated ally. Why does inflation keep happening? It's not an accident. It's the system's backbone. It funds wars without tax hikes, wipes corporate debts, and boosts asset values for the rich. Tograstis, let's rewind to when inflation was a crisis, not a strategy. In the 1800s, money was tied to gold. Every banknote matched metal in reserve. This kept prices steady but rigid. Governments couldn't print cash freely. Inflation only spiked during wars or disasters, a sign of chaos. Could you imagine a world where inflating money on purpose was unthinkable? Then, the 1929 crash hit. The Great Depression flipped everything. Deflation took hold, prices dropped, debts grew heavier, spending froze, economies collapsed. By World War II's end, nations faced crippling debts, some over 200% of their economies. Repaying honestly was impossible, so they didn't. Inflation became their silent fix. Through the 1950s, debts shrank not from growth, but because money lost value. $1 billion owed in 1945 wasn't the same by 1960. Who benefited? Those holding assets, not cash. In 1971, everything changed again. Nixon ended the gold standard, untying the dollar from metal. Money became a promise, backed only by trust. Governments could print endlessly. Banks expanded loans. Investors realized inflation rewards borrowers, not savers. Inflation turns debt into wealth for those who own. If you save cash, inflation eats it. If you borrow smartly, it shrinks your debt. A $500,000 loan today feels lighter in a decade, while your home's value soars. This isn't luck, it's math. Inflation fuels a debt-driven world. Without it, every loan would demand repayment in full value dollars on unworkable system, so central banks aim for steady inflation, around 2% yearly. It sounds small, but over decades, it halves your money's power. Why don't wages keep up? Workers lose ground while asset owners gain. Savings erode, forcing you to chase investments or borrow to survive. The Cantillon effect explains this. New money reaches banks and elites first, before prices rise. By the time it hits you, it's worth less. In the 1700s, it was noblesse. Today, it's hedge funds. After 1971, borrowing became king. The 1980s cemented this. Central banks mastered stable inflation, keeping economies growing while quietly taxing savers. Ever wonder why thrift feels like a trap? Saving at 2% interest while inflation's 4% means you're losing money. Meanwhile, property owners see double-digit gains. Inflation doesn't just raise prices, it tilts the game upward. The 2008 crisis proved it. Central banks printed trillions to save markets. Stocks and homes rebounded, wages didn't. In 2020, pandemic spending spiked inflation again. Supply chains broke, prices soared, and the wealthy owning assets thrived. History repeats. In Weimar Germany, industrialists gained, while workers starved. In the 1970s, real estate boomed while savers lost. Why does this pattern persist? Because our economy thrives on credit, and credit needs inflation to breathe. Central banks fight inflation but never kill its hero. Inflation would crash the system. Deflation buries debtors, stalls growth. Inflation keeps the machine running, even if it grinds down workers. Inflation isn't chaos, it's the system's heartbeat. It shapes behavior. Spend now, don't save. Risk, don't wait. It's why the rich borrow big and win bigger. Like Finance History Vault, and join us to uncover more. Inflation isn't the floor, it's the plan. It's how wealth flows upward, and history shows the way.